All right. So good morning, everyone, or good afternoon at this point. Again, Jessica Cook here with Blue Ocean Title. John King here is with First American Exchange Company. He's also an attorney, so he comes with a wealth of knowledge. He's a great partner for us. Ask questions as you like throughout the presentation. He's going to touch on FIRPTA as it relates to 1031. He is an attorney, so I'm sure if you have some questions past what he's going to present on, I'm sure he'll try to answer your questions for you. So without further ado, Mr. John King.
Thank you. I'm supposed to wait till the end to clap in case I'm really.
Well,
You're
we
good.
just want to make sure you get the plug at some point.
Appreciate that.
Now you have to do well.
Yeah, there you go.
I have no choice,
There you
right?
go.
I have no
That's
choice.
positive enforcement.
Yeah.
I think
I
it's
like it. I like it.
Okay.
Yeah, this is just a quick overview of FIRPTA and 1031. But I like to keep it super casual. So if you have questions, you are welcome just to ask me. We may touch on it again as the slides progress. But really, I'm just going to give you a really quick overview of 1031, kind of just initial thoughts you should take with you. And then the FIRPTA stuff, it's just come up a lot lately with foreign sellers. And in and of itself, they have FIRPTA issues, but when it comes to 1031, there's a couple other steps or options. And so if the person is prepared, they can use 1031 to defer the FIRPTA withholding that would otherwise be due. And if they're going to stay in real estate in the US, this is a perfect tool to help them do that. Okay? So we'll spend the first few minutes on FIRPTA.
I don't even see the.
They were all fighting over it, you know.
Oh, wait a minute.
Let me make sure I'm pushing the right button.
Let me move this to the other side.
Sorry,
Is the power on?
I think so. It was just working a second ago, but we could just manually do it if you
Oh, that's fine. Yeah. I'll just
arrow down.
Just
That
let me
should
know when you're
work,
ready.
right?
Yep.
There we go. So is everybody here familiar with what FIRPTA is? So if you're a
I know what it
non-US,
stands for, that's about it.
yeah, so it's the Foreign Investment Real Property Tax Act. If you're a non-US citizen and you're selling a US real property business, you're subject to this withholding, depending on the type of transaction. So first little bullet point here, if you're selling something that's under 300,000 and the person that's buying it is going to occupy it as their personal use asset for more than 50% of the year, there's no FIRPTA withholding here. If you're between 300,000 and $1 million, then it's a 10% withholding if you're going to have that occupancy of 50% or more. Everything else is 15% withholding. So that's for foreign nationals individually, their corporations, their trusts, etc.
So wait, did you say it also has to be personal use or can be rented?
So in order to qualify for the zero withholding,
Right.
the buyer
Right.
has to assert that they're going to use it more than 50% of the time personally. If not, then the withholding is due. So really, it's
Okay.
the problem, or not the problem with FIRPTA, but the issue with FIRPTA is that it's the buyer's responsibility. So if you have a foreign seller of something that you're purchasing, it's your obligation to collect and remit it to the IRS. So if you're going to allow a foreign seller to not pay FIRPTA, meaning then you're not going to collect it and turn it over, then
The buyer.
you have to be conscious of the fact that it's only not due if you're going to use it 50% or more of the time. If you're not going to, you should collect it and you should remit it.
Okay, so the 300,000 to the 1 million,
That's a 10%.
that's a 10% plus personal use.
If you only want to have the 10% withholding.
Yeah, otherwise it's 15.
Correct.
Okay.
And so the IRS will come after you for this. I just met recently with a realtor up in Northeast Florida who bought something from a foreign national. They escrowed the FIRPTA withholding, but she never thought to follow up to get it sent to the IRS. At some point, the escrow holder said, I'm done holding this. I'm going to turn it over to the state.
Wow.
And then the IRS came knocking saying, where's our money? And so it's been just a complete fiasco trying to get that money back to this particular realtor so that she can turn it over to the IRS. And because she didn't do it immediately, of course, they want interest and they want penalties. So she's in the middle of, negotiating, hopefully, elimination of those components and just get the money to the IRS. Like
So
that.
these are the real.
Yeah. No, so she's a realtor, but she was the buyer.
Oh, I see.
Okay.
Oh,
Yeah.
okay.
So it was a personal deal.
So is there a time frame that you've got to say you're gonna use it for personal use? Does it expire after a certain period of time, or is that just for your entire?
No, it's either for 12 months or 24 months. It's on the next slide, I think.
Oh, okay.
It's either a year or two. I can't remember off the top of my head. But it's either for a year or two. So then, what are we concerned about here? We're concerned about real property interests. Normally, you're gonna see it where someone's selling a condo or a single family residence or something of that sort. But there's some other items here, leaseholds, options, et cetera, that you may not ever come in contact with, but those are considered US real property interests and are subject to FIRPTA. We'll go to the next
I
slide.
think get your clicker working.
Oh, is it working again?
Yes, sir.
Make sure maybe it's just me.
Nope, just you. And every time I click, it keeps skipping a page.
Well, okay, so what's the implication of that? I was wondering if you were heading to it on this slide. You go back for a second,
Mhm.
and that US RPI, what's the significance of that? for
It's
us?
United States real property interest. So if you're a foreigner in the US selling something in the Bahamas,
Mhm.
this is not gonna apply.
Okay, so it,
So we're only concerned
the
about
FIRPTA tax is,
US real property
that's
interests
what I wanted to know.
internal to the US. Yep. Okay, we'll go to the next one. I don't know why I can't get this thing to work.
I know. I
This is
think
the
the
arrow,
battery,
right?
yeah, I think the battery's starting to die.
So who are considered people subject to FIRPTA, non-resident aliens, so those people are here, don't have a green card, et cetera. Foreign corporations or partnerships, foreign trusts, et cetera, they're all considered foreign persons. And so we're concerned with FIRPTA when we have a foreign person who happens to be a seller. We'll go to the next one. So how does this apply with 1031? So we know we have this withholding if you're a foreign seller. Now I have a customer, let's say, that's either buying or selling from the foreign party. And so now it's gonna come to a head, right? So we can look back to the three tiers. If normally what we would look for mostly is if it's 300 or less and the person who's buying is gonna use it, then we know we're not subject to it. If we are subject to it, then the customer, if they're the seller and they happen to be the one trying to defer this FIRPTA, this is where they start asking me questions. What are their options? How do I not have to have this withholding occur? Because I'm intending to go back into another piece of real estate. So really it comes down to three choices. They're all based on timing, candidly. And it just really comes down to the fact that some of them we can use because people are being diligent in their planning, and others we can't because they're not. They think they have this epiphany at the last second when they get their estimated settlement state and they go, what is this giant withholding thing here? And now they're worried about how they're gonna overcome that withholding. So the easiest way to do it is to apply for a withholding certificate from the IRS. Now, it takes the IRS, it was taking them around 90 days to do this. I think it's taking them much longer now to actually issue the withholding certificate. But basically, if you're a foreign seller, you can say, hey, IRS, I'm intending to do a 1031 exchange. Therefore, there should be no withholding because all the money's going to get moved forward. Give me your blessing. I can give that withholding certificate to the buyer. No withholding occurs. Now, that has to be issued before the closing. Can't just have applied for it. So that's where people get messed up with this particular choice, is they normally haven't thought about it that far in advance of closing. So there's no way it's going to get applied for and issued by the time we close. Okay, so that's option one.
You have a question on that one? Okay, so you got a foreign person who doesn't have an ITN, right, number,
So in order to get the withholding certificate, you have to apply for one,
right?
but there's a special provision where you're applying for it only for this real estate transaction purpose. So that's the second hurdle for that withholding certificate. You got to do both at the same time. Get your ITN, get your withholding certificate.
So to get the ITN, you go to text, whatever, you have to send your passport.
Right, there's a form you actually fill out and send it to the IRS, and then that gets you the number.
But
And then you get the-
you have to send your passport.
Your
Like, is
physical
there any other
passport.
way? Because if foreign person is only here for like a couple of weeks, then he doesn't want to lose his passport. So how do you work around being able to submit to get an ITN before the closing?
Yeah.
Without giving up your passport?
I would like to say that's not my problem.
Ah, okay.
That's,
Okay.
that's really the person that wants its issue, but it is an issue. All of these logistical things play into being able to get this withholding certificate.
So always sooner rather than later.
Always sooner than later. I would tell you that in most instances where I dealt with this, in years past, we always had withholding certificates, it seemed. Lately, never one. I think it's just timing, because the market being crazy, you know, you have this idea that you want to sell, you haven't thought about anything else, you just want to get the thing sold and move on. It's seldom that we see a withholding certificate. Go to the next slide. We'll go with one more. So the other one is this, obviously, if you're below the number, and I've had a couple instances recently where we've been really close to 300. And what had been decided is we would make the number 300, just to make it simpler on everybody. And they were able to finagle closing costs and that kind of stuff to make the numbers work for them. But this, you know, we were like at 305.7, and I'm like, you can go through all this craziness, or just make the price 300 and you guys will be good. So that's another option that's in there. We'll go to the next slide. Another one that works really well, if the client is prepared to do this, is have a simultaneous transaction within, what I mean by that is within 24 hours. So if you can structure your sale and your close to occur concurrently or simultaneously, then you can write a letter to the buyer that says, you're doing this simultaneous or concurrent closing, therefore no withholding is due. And they can take that letter and send it to the IRS, and that is compliant with FIRPTA. Now, from a buyer's perspective, how do you ensure that it's actually transpiring concurrently, right? That's one issue. If it's in the same general area, you're probably in communication with everybody anyway, so probably not an issue. But if you're selling in California, for example, and buying in Florida, and I'm the person that's responsible for collecting and remitting, and you're saying I'm doing a concurrent transaction, therefore I can take the letter and submit, how do I get comfortable with that? So that's the only hurdle we have in that example, but simultaneous closings are really good to help get around this FIRPTA withholding.
Can you explain really quick, why is it the buyer's responsibility to
Because-
collect that money when the seller is the one
Who's
that
making the money?
Because if you're a foreign party selling and you leave the country, what's the recourse of the IRS?
Why am I stuck with that?
Because
That's
you're a US taxpayer presumably, and the IRS can chase you easily.
fine. But it's not my money.
So they make it your responsibility because they know that they can collect from you. Because their job is to take money. And your job is to try to not give them money, right? So they just make the onus on the buyer of the asset. Now, I just had one recently where the seller was a FIRPTA, a seller foreign party. Excuse me, so we had FIRPTA issue on the disposition side. On their acquisition side, they were buying from a foreign party. So now I got two foreign parties. One's a buyer and one's a seller.
Mhm.
And none of them had ITN's numbers, tax ID numbers. We were in a dilemma. How are we going to do this? Because now my buyer, who's technically responsible for collecting, is not a US citizen. And everybody that's looking at the forms are going, all right, the only thing that we're gonna do here, we're just gonna withhold. We don't care at this point. And then you guys sort it out. If it's an issue, go to the IRS, file the appropriate forms, get your refund, whatever you want to do, but this is the fallback we have because we've got two foreign parties here.
So because I'm new to this is new.
Mhm.
If I have a buyer, why isn't the closing attorney doing that?
Because it's not their job. So the IRS is very clear whose job it is. Now, you could ask somebody else to help you do it, obviously. And there are lawyers that I'm aware of that will assist parties through this, but really it's the buyer's job, right?
Jessica, do you know?
And like,
I don't know that we've done them before, but I think the situation that we kind of, a scenario situation is that the escrow fund. So they just sit there and sit there and sit there, and then eventually, like, we have to just send them.
Right, because you only have about a 20-day window post-close.
So that's why
To
they
get
don't
this
really
worked
want to
out.
do it.
And this is just for the federal level, so I do a lot of transactions in other states that have state income tax. And most of those jurisdictions, if you're a non-resident of their state and you're selling investment real estate or just real estate in general, they have their own version of this FIRPTA at the state level. And so in those particular jurisdictions, it usually is the closing attorney who's handling it because it's just part of their practice that they do. But here in Florida, for example, it really isn't escrows or titles problem. It really isn't a lawyer that's working on the deal because, unless they're actually doing the closing, they're just advising. So it really falls on the onus of the buyer. And the problem that I see a lot when I become involved in these deals is no one really advises the buyer that they're on the hook. So you could actually go to close, have all the disbursements occur, and then realize that you're supposed to be collecting and remitting. And if you haven't done it, good luck chasing down the foreign seller who's left the country, right?
So in the HUD, in the closing disclosures, that's being prepared by the title
Mhm.
company,
Mhm.
isn't that listed there? Like, how do, because I'm a buyer and I've been buying.
Mhm.
I have never heard of this, so if I would have gone out there and bought a house yesterday, I had no idea about that,
If
so.
it was a foreign seller.
Yeah, it's a dilemma. I mean, so 1031 is a good example too, right? I'm a lawyer in California and Florida, so I've taken the bar exam twice. 20 years apart, believe it or not. There's nothing I had to learn in law school about 1031. No, it's not tested on the bar exam, right? But people think that since I'm in real estate and I'm a lawyer, that I should know everything about 1031. Not true. Same thing, CPA exam. You don't have to know anything about 1031 to get your CPA license. Realtors, right? When you got your sales license, what was there, one paragraph in the review materials about 1031? Broker's license exam, 2 paragraphs. So everybody in the marketplace who's dealing in real estate has a presumption that all of us in this room know everything there is to know about real estate. And so you can bet if you're a buyer and you're acquiring from a foreign seller, and now you're on the hook and you haven't collected to remit, guess who's gonna get their finger pointed at them?
What is the
All
right,
of you and me, right?
what is the right way to collect that money?
And I think at
I'm
close,
at the closing table.
Yep.
And, okay, everything is there, and what I said, hey, you need to write me a check. How can I-
it should be a line item on the closing statement, and it should be put in escrow if it's not gonna be immediately remitted,
Okay.
and then it needs to get remitted within 20 days. So ideally, if, excuse me, if you're a buyer, and I tell this to people all the time, when they're foreign sellers that are in a 1031 that I'm helping them with, and they're trying to come up with all these creative ways to avoid the withholding, I tell them, look, if I was your buyer, I'd make you pay it, and I would remit it, you can go chase it. That's just me. There are methodologies to avoid it, but if I was your buyer and I was uncertain of the path forward, I would just say, it's gotta be collected and remitted.
But at the end of the day, as a realtor,
Mhm.
what I'm saying here is, my advice is hire an attorney.
Yep, absolutely.
I have no idea
Right.
if that person bring me a piece of paper saying, with this, you're
Yep.
good. I don't know.
And it's true. So, the example I was given earlier, the seller was from Scotland. And then they were buying in South Florida, and that seller was from Brazil, right? So when I was working on the withholding issue for their sale, it was to a US taxpayer. And so we ended up doing the letter for the concurrent closing, and we had the CPA for the Scottish couple prepare the letter on their letterhead. And we gave it to the buyer so they could take it to their counsel and say, okay, I can verify that the references in this letter to particular code sections are accurate. And if everybody's doing what they're saying they're doing, and I can see all the money go from this closing over to this next closing, because I get to see both settlement statements, then I'm good with the letter.
Another thing is my buyer now have more money to spend because in a normal situation, just buy and sell and that's it. But in this situation, because the seller of the house, my buyer like, is a foreign, he have to pay more money in the attorney to deal with all these things.
Right.
So it's another expense too.
Right, and so, you know,
The seller does?
why do,
Buyer.
Yeah,
yeah, you know, why do people not hire lawyers and CPAs and
money.
money, right? The people are cheap, they don't wanna pay, but they really should be hiring professionals and get this kind of advice, for sure. Okay, you,
Are there disclosures that say this is a foreign property?
Yes.
Cause I've never seen one, so.
Yeah, that was
I've
my
never
next question is how do you know if they are foreign?
It's on the contract.
there's a non,
Contract would we do a listing, but I've never looked for foreign seller.
well, so there's a,
Right.
isn't there typically a
And
foreign,
name
non-foreign
of the-
seller
of the
affidavit that you
owner?
have to check in the contract?
No, when
in
we
closing?
do listing for Daytona, you have to say, is this a foreign seller? That's all I've ever seen, is what I'm saying is, I don't know if anybody else has come across that. Is there a disclosure when you purchase the property for a foreign seller? Or do we find out later?
There should.
Well,
So
I,
you've got it on the list side, but you don't really have anything on the buy side that tells them.
If I go to see your house and her, is this a foreign seller? I've never, cause I wanna know now. I wanna know ahead of time, so
Yeah,
that my buyers
well, I
know.
think on the title side, because they're gonna issue 1099s, they're gonna be asking for tax ID information.
Yeah.
And obviously then if they're a foreign seller, they're not gonna have that. typical-
And you have to sign something at closing as well, with the form.
well, if you like this house, you have to. pay-
Yeah, right.
Invest a little bit in
We're gonna jump
attorney
through hoops, you don't have your down payment, but.
So does buyer pay you a retainer?
So I'm just I'm a qualified intermediary, right? So we charge a flat fee for our service. So I'm not getting any more money than I get on a normal file if it's FIRPTA related or not. If they're wanting to get advice outside of me, then they should hire, I would typically push them towards CPA initially. Because it's all forms that have to be filed with the IRS. And if you're not a tax attorney, you're not dealing with the IRS. So I typically push people towards CPA first. And if they're not comfortable or can't find CPA, they could get a tax attorney that can help them.
So they give you a forged letter or that something goes wrong, then they're coming to you and that's included in the retainer?
So they're not coming to me. I mean, I'm not, I don't provide tax or legal advice, overtly, kind of covertly do it. No, but they're not hiring me to be a tax or legal advisor. They're simply hiring me to act as QI. So if they're really concerned about it, they should hire someone that's expert in the field. But it really is kind of benign. Where you can run into issues, and like, I'll give you an example, South Carolina. If you're a non-resident of South Carolina and you're selling a piece of property there, there's the same process, right? But what the buyer can do is they can retain me as the qualified intermediary to say that if we end up in a situation where there is some tax due that has to go to the state of South Carolina, I will send it to them. So what that means is money comes into my exchange account. If for some reason there's what we call boot, which is partial taxability, money left over or something, which triggers gain that has to go to South Carolina, I will withhold it from the exchange funds, send it to the state of South Carolina, and then remit the balance. And so I've contractually obligated myself to the buyer in that situation to do that, if they request it. It's not a requirement, but they can ask me to do it. if
Is
they
there,
want
is
to.
someone help? I was gonna say, couldn't you get wiring instructions to the title company directly to the IRS?
They could.
That's how I would do it. I would just have the wire.
I mean, I don't know that they'd want to do that, but
But
you
if that's
could.
something you offer.
I mean, it's a possibility, but like he said at closing, it's better just to issue a check immediately and just
Yeah.
send it out.
yeah, if I was the
Send it to
buyer,
the IRS.
Correct.
if I was the buyer and
Yeah.
was gonna remit, I'd get a check and just.
Yeah,
So it's-
not hold
it's as
it.
Easy as if it was a regular bill, like sometimes the contractor does a work and gives you a invoice.
Mhm.
And you give it to the closing attorney and they write a check.
You could do
and
that.
it's done.
Yeah.
Right.
And
So
just say,
that could
this is
be
where
as
it goes.
easy as that.
Because if you get the FIRPTA withholding information from the IRS website, it actually tells you where it's supposed to go. So you could just say, as part of the closing instructions, a check for X amount, because based off the gross sales price, so it's an easy calculation. A check for this amount needs to be sent to this address, and
Yeah.
it could just go right there,
So-
and then provide the
That's
appropriate
easy.
forms.
Yeah.
It's a couple forms.
Recover the money.
That's that.
How does the buyer recover
The buyer,
Yeah,
Well, if you don't
Somebody's
collect
paying
it, if you don't collect it at closing, that's a good question. How do you get it?
yeah.
No.
So do it at close.
There's a reason why you have to.
You have to do it at
Wasn't there
closing, because if
an
not,
instance
you're
where
not
you were
gonna
talking
get it.
about where the buyer got penalized for holding the money or something like that at one point for longer?
Well, so, I mean, technically, you only have 20 days to remit,
Right.
right? So one of the workarounds, if it's not a simultaneous closing, but let's say it's a 2-week gap, I could say, I want the withholding to occur, and I want it to be held in escrow. Because we know in 2 weeks, we're gonna be making the acquisition and no tax will be due. So you could hold it for up to 20 days. If that closing doesn't occur in that gap period, then yes, if you haven't remitted it, you could get yourself in an interest and penalty situation with the IRS.
Right.
So, this is, you can't collect money from people that are absent from our country. So this is the only way the IRS can ensure that they can get those sums that are due. So that's why they're making it kind of onerous on a buyer who's really saying, it's nothing to do with me, but this is a way they can make sure they can collect and move in. What normally happens in these withholding situations, because it's hard to get concurrent closings, I'll be candid with you, is the withholding will occur. It'll be sent to the IRS. The customer that's trying to get the deferral on the withholding will fund out of pocket the same amount to the exchange account. I'll use it to buy their replacement property, and they'll apply for a refund to get the money back from the IRS. So we can get from point A to point B at some time. It's just a matter of how long it's gonna take us and what other hoops are gonna have to be.
So
gone
I
through.
guess there's a lot of communication between the seller and the buyer here, because over there in Georgia, they don't talk to each other at
Well,
all.
and
But here, I guess they do.
well, I'm gonna respectfully disagree. Because this is my biggest pet peeve in real estate transactions. And Florida is more guilty than most jurisdictions that I do business in. And that is, if I look at a FAR contract or NEFAR up in Northeast Florida where, I live in St. Augustine, so I see NEFAR contracts all the time. I don't know which one you guys use predominantly here. Is it FAR? Okay. In FAR, there's a section to put all the seller and buyer contact information, right? I will tell you that if I see a contract a year that has those sections completed, I am shocked and fall out of my chair.
Yeah.
Why? Because you don't want the buyer talking to your seller.
Right.
And that the other agent doesn't want your seller talking to their buyer.
Yep.
So here I am when I'm doing deals and I need everybody's contact information. It's not where it's supposed to be in the contract. And nobody does it. So don't feel bad that you're not doing it,
Well,
but nobody does it. But it's there for a reason. So my rationale is, if you're not gonna fill it out, then they should take it out of the
Agreed,
contract.
yeah. agreed.
That's my opinion.
Agreed, yeah.
Because otherwise, I'm looking for it and it's not there.
Two things. One, so I thought FIRPTA was sort of a federal thing. So I'm confused why it sounds like it's state specific as to, you
Well,
know.
here we don't care because we don't have state income tax. But if you have customers coming from other
Okay,
jurisdictions,
So this is a state withholding, this is a state.
this
tax.
one is federal. Every jurisdiction in the United States
It's only if we're a
is the
tax.
federal,
or a
it's a
state
federal
tax
collection.
That's
If you,
additionally.
if you live in a state with state income tax, they have their own version of this as
Oh,
well.
I see.
Yeah.
Okay.
So you get double dipped. So in South Carolina, for example,
Right.
if you're a foreign seller, not only do you have your federal withholding,
Yeah.
you also have state withholding. So it just depends on where you're at in the country.
And then my second question is, what does a QI do?
Well, we're gonna get to that.
Okay.
So that's kind of a quick overview of FIRPTA. It's not really overly complicated, in my opinion.
Oh,
It can seem so.
in my mind, you have no idea.
It can seem more problematic than it is, but if you have someone that knows a little bit about it, it makes it really streamlines the
Your
process.
brain works in that way.
Yeah, I mean, you just like me, I just get used to seeing it, so I've done it so many times,
We'll be calling you when it's out,
Yeah, yeah.
okay?
That's what he wants.
Again, it's only if you have a foreign seller that's trying to do a 1031 exchange because they don't want to pay the withholding. Otherwise, they're gonna do the withholding.
Actually, I have an actual client, he opened an LLC here, but he lives outside of the country, he's not a US citizen or resident.
Yeah.
So.
Now, that entity might be a US entity.
He's a US
Right,
entity.
so it may not be subject to.
He will
FIRPTA.
be buying properties here,
Mhm.
and eventually he will sell,
Mhm.
Yeah, that is, this apply for him or not, for that
It,
LLC?
it should, because now we're talking about a United States entity with a tax ID number,
Yes.
Uh-huh.
presumably.
Yes.
So now we're not as concerned.
What you're saying is a foreign buyer, nothing's different done.
Nothing different with a foreign buyer.
Okay.
Yeah, we don't care about foreign buyers.
There we go.
I mean, we care.
That's
We
what I
like-
wanna deal with.
Let's go to the next
I
one.
know, I was just gonna say, what, my takeaway is so
we'll
far.
go to the next one.
All
All right, so we're done with FIRPTA. Okay, so now we'll talk a little bit about 1031. So, who's done one before? Anybody?
I'm getting
How long
close.
ago?
Yeah, I came from California, so I came there. So I know.
Me too.
It says, we put in there at no cost to the buyer. So participating in 1031 exchange at no cost to the buyer.
Yeah, I lived in California for long enough to know I'll never live there again. But
Same.
I lived
Get
in
the
Southern,
word
I
out
lived
so
in
they stop
Southern
moving
Cal.
here.
Where did you live?
Northern, south of the Lincoln.
Okay.
Back in-
I lived in Orange County, Laguna Beach area. Very pretty. There, it's
Very
very,
beautiful.
it's gorgeous.
Yeah.
But it's,
Very expensive.
it's a crazy zone.
Used to be
Um,
more just-
So, yeah, I will, my wife would move back there, but fortunately she has a good job, so she can't leave. But she would go, and I don't want to go. But we'll talk about 1031 now. So this is a tool that's designed to help people that own investment real estate defer capital gains tax that they would otherwise have to pay if they sell their investment property. So,
Add it, you know.
yeah, and this is gonna, for you, most of the time, you're gonna, when you think of investment, just think of a non-owner occupied property. Okay, condo, single family, whatever it is, that's a rental, just if you can keep it as simple as that, right? It also does apply though to what we call trade or business use assets, so like this building, it's in a shopping center, obviously, and somebody owns this center. And it's a trade or business use asset, or perhaps an investment, they probably can classify it either way, but they could do an exchange on this. Where I run into trade or business use a lot is veterinarians, for example, dental practices, where they actually own the building that they operate their business out of. That's gonna qualify for 1031 treatment, if they're trying to dispose of it and do something with it.
They just don't live in it, they don't reside in it.
Correct, non-owner occupied.
Okay, what about in the case of snowbirds who want to rent out for more than half the year or less than half the year, whichever is to their advantage, okay, and live to the other half?
So that gets into what's called a qualified use issue. So the IRS has very specific things that they describe as to what they think is satisfactory and still allow you to call something investment, and what they think is not. And so, good or bad, it's not a clear delineation. And so it's really a risk assessment. So if someone says to me, I have an asset and I live in it part of the time or use it part of the time and I rent it out the rest of the time, then the question becomes, okay, let's have a better description of how much you're using it for personal use, how much you're renting it out. And then you can take my input to your CPA and say, what's my risk level here? Am I okay with saying it's still
It's
investment?
yeah.
Or am I not, and now it's second home and doesn't qualify for any special treatment? So it's a fine line that you walk if you're using something that you're calling investment, but you're also using personally.
So piggyback per question, what if you had somebody that was their primary or secondary and they knew about this 1031 benefit throughout the year, and then they say, okay, well, we really want to change the usage at the last minute and put it in like a different kind of entity.
So we have the same qualified use
okay.
issue. So there's nothing that prohibits you from converting uses. So let's say I buy,
Okay.
and we do this a lot for estate planning purposes. I buy a condo, I'm gonna rent it out for the next 10, 15 years. But at some point, I'm gonna move into it, because it's gonna be my retirement home.
Right,
So now I've rented it out for 10 or 15 years, and now I'm moving into it. Now I've converted it to my primary use. How long do I have to own it? And how much am I gonna be able to exclude under the primary residence exemption or exclusion? That's one part of the conversation. And if you have a lot of time, it's a non-issue. It's when people try to convert immediately prior to disposition or after disposition. or acquisition, that's when they start to have issues. So it is actually a good example. You're up by me, and so, and here in Daytona and New Smyrna, all these areas on the beach, right? They've gone through the roof value wise. And so St. Augustine Beach, let's say, you could buy a house on St. Augustine Beach 20 years ago for a couple $100,000, right? Let's say you bought it for 250. You probably sell that same thing now for 2 million, right? So it's my primary residence. And let's say I'm married, under the primary residence exclusion, I can only shelter $500,000 of that gain. So if I'm in it for 250 and I'm selling it for 2 million, I got $1,750,000 of gain in that transaction. Under primary residence exclusion, I can only shelter 500. So now I'm paying tax on $1,250,000 because my house went up so high in value. So what people will do is they'll move out and make that house a rental and do a 1031 exchange instead of just a 121, and they'll actually combine the exclusion and the deferral together. So they'll take their $500,000 that they're entitled to, and they'll defer the balance. Now, how long after you convert it, do you need to rent it before you do that? That's the open question.
Ballpark?
Say that again?
2 of 5, you have to be in it, or is that for tax?
Say that again?
2 of 5 years?
Well, so now we're talking about the requirements of the actual code section, right? So in a normal 121 situation, as long as I live in something as my primary 2 out of 5 years, I can take the exclusion. Okay. If I've converted it to investment, then I've got a different holding period. And then I still have the same use requirement. And then it's a calculation that compares one kind of use versus the other kind of use and how much the exclusion actually applies, right? So where we run into though, you take your what was primary and make it investment, is how long do you have to rent it before you can do a 1031 exchange?
Yes.
And it's an open-ended question. I think a lot of conservative people would say, do it for 2 years.
Right.
There's nothing that says that, but that's kind of what they've glommed onto. 2 tax years, it's not 2 physical years, but you filed 2 tax returns. Maybe that's enough.
So there's
Maybe
nothing
it's a year.
black and white saying 2 years or something?
Or 2 weeks before it's
This is the beauty
listed.
of our system, right? We all get to make our own argument.
But if
It's
you're
whether,
doing it wrong.
it's whether we're successful.
I don't wanna tell you, but if you do it wrong.
And so it's really, you'll notice anything I ever hand out, it always says, go talk to your tax or legal advisor.
Oh, sir.
Because it's a risk assessment. I have customers that are so risk averse
Yeah.
that they'll wait forever to do anything. I have other customers that roll the dice and go, let them come after me. I'll hire a high-powered tax lawyer and I'll fight them till they're blue in the face. I'm gonna win because that's just how I act and that's how I operate. And they don't care. They push the envelope, which is their right. None of it matters until they get audited. And so what I always do, my approach on these kind of questions is I will tell you the spectrum of answers that are available. And then I'll defer to you and your advisor to make a decision. If I think you're being really crazy, I'll tell you, hey, this is really, really aggressive. So you should be prepared that if you get audited, you're going to have to answer this particular question. But if it's really close to being ultra conservative, the likelihood is even if you get audited, you're going to prevail. So why not do it? But it comes down to this. You always have a choice when you sell investment real estate. You can write a big check to the government, or you can do a 1031 exchange. As long as you never get audited, no harm, no foul. If you do get audited, you just want to be prepared to answer the correct questions or answer the questions correctly so that your 1031 is not set aside and now you owe the tax.
Someone purchases something with cash, and the reason I say that is because with a mortgage, then I would imagine it has to be stated if it's residential use or for investment purposes.
Yes.
But if they purchase it with cash, can they, after they've already purchased it, can they flip it to make it a investment if they decide not to move in? Flip it and make
Well,
it
when you buy something for investment, it can be 100% cash, it could be leveraged, it makes no difference.
Okay, so then yes, they can flip it to 1031 exchange? If they,
So-
I mean, to investment, and there's a second part to my question.
Well,
based on that
so-
answer.
I'm gonna answer your question based on my experience in this particular
Please,
situation that
please,
you're
yeah.
mentioning. You know what I call that situation? Tax fraud. I mean, mortgage fraud. Because I'm going
No,
on
I'm
my.
saying no mortgage. They
I'm
buy
cash.
Yeah,
cash.
so, but this is the game that you're skirting the game by your particular facts. But this is the game everybody plays in the
Okay.
1031 world
Okay,
that has a mortgage against their property, and they have to go get a new mortgage.
right,
They all go to the lender and say, this is the second home I'm buying,
right,
because they don't want to pay an investment rate.
Right.
And if the lender is going to service the loan, they probably don't care. If the lender is going to sell the loan, which
Most
most
do.
conventional lenders
Yeah.
are going to,
yeah,
then they do care.
Yeah.
And so, but again, we all have our choices and battles to face. People are gaming the system by
Yeah, sure.
saying it's this and then it's that. Now, your example, if you just buy something for cash,
cash, yeah.
that's still investment. Doesn't make a difference. If your intent is to rent that house out.
No, it wasn't. I spoke with someone
Okay.
today, who just bought something last week, brand new construction.
Okay.
And her boyfriend bought another and they decided that they're selling hers.
Right.
Can she avoid the capital gains by making this an investment property instead?
Is she
She never
gonna-
moved in. She bought it last week.
Is she gonna sell it or is she gonna
No,
rent
she
it?
needs to sell it. I talked to her this morning about possibly renting it. I mean,
So my response to that question would be,
Yeah.
she can do whatever she wants. But here's with the caveat that
Yes.
she needs to be able to document that her intent
Mhm.
was to acquire this thing for investment.
Oh,
Okay.
and it wasn't, and I wouldn't ask her to do that.
Well, she could write a letter to her CPA and say, hey, I just bought this house for investment. Okay.
She's not making.
Or
If-
what if she just changed her mind?
Yeah, and if that were the case, Yeah.
North Margaritaville, she'll make $100,000.
yeah, and if that were the case, then she could say that and move forward.
Minus capital gains.
Now, the
sorry.
problem you have is you've got a short hold period, right?
Right,
So the IRS does not like people that buy, fix and flip doing 1031 because they hold stuff for inventory or resale. They want you to hold.
Yeah.
To support your expressed intent that you bought it for investment.
so she needs to rent it first.
And so, it's not necessarily, but what she's got here is a situation where she says, I bought it for investment. Everything surrounding the circumstances suggests otherwise, if I'm the IRS. And so if I want to challenge this, I would say, you bought this thing and a week later you sold it. And I'm gonna say, well, let me look at your history in real estate. Where do you earn the bulk of your income? A lot of ancillary questions that I can ask or look at to say, all right, you did this. Am I going to uphold your 1031 treatment? Or am I going to try to attack it? So I always tell people this, I'm not the exchange police. And I don't report these things to the IRS. So in that particular example, are you being super aggressive? I would say yes, but I would never tell you don't do a 1031 exchange. You now need to do a risk assessment to say, all right, if I sell this thing and I'm making $100,000,
Minus capital gains, that's the
yeah,
point.
then I owe 20 grand. Well, let's say in taxes, we'll just use 20%. Now I owe 20,000. Actually, they would owe more because it's short term, not long term,
Mm,
because it's less than a
yeah,
year. So let's say it's 25 grand. I can sell this and pay 25 grand.
Mhm.
I can set it up as an exchange and defer it. Hope that my arguments are sound. What's the worst that can happen? You get audited, your 1031 is set aside. Now you owe the tax.
No penalty.
No penalty probably unless you're acting in bad faith. Now, are you being aggressive in this particular circumstance? Sure. But are you acting in bad faith? I don't think so. Because what is the definition of investment? Everybody has their own
Yeah,
definition,
good point.
right? I mean, I might buy, if I buy vacant land, it's clearly not for income. It's for appreciation presumably, right?
Uh-huh.
Now, if I bought it last week and somebody comes along that's a developer and goes, this is exactly where we want to be. Here's $1 million extra than you just paid for this thing. We want it. Should I not be allowed to do a 1031 exchange? I had planned to hold it, but now an opportunity has presented itself. Should I not take that opportunity because it's a short hold period? That's the analysis that people need to go through.
And with her situation, you could state that. I mean, if it were me and I was that owner, I mean, yeah, it's your primary, but you have the future intent of either renting it or selling it. You can leave out the selling part and say, like he said, state it to your,
Was that our primary?
oh,
So it's
But she
it
was
really,
gonna move it.
yeah, it's
So
just, it's
it
just
was-
risk.
yeah.
Risk analysis
Yeah.
is all it comes down
Yeah.
to. Obviously, when you're looking at this as a spectrum, the more conservative you are and the more I's you dot and T's you cross that look like what they want to see, the safer your deal. The more aggressive you are, the more you just need to paper your file for your transaction so that if you get challenged, you have an answer that is responsive to what their challenge
Got it.
is. This happened a lot recently, 2018 until the interest rates went through the roof, but people were buying stuff and other buyers were coming to them the next day and offering them
Right,
100 grand
more.
or 200 grand more.
Right,
What were they to do? They didn't have any plan to flip it.
right.
Most of them didn't. But why walk away from that opportunity? Now, if you're in the business of flipping real estate, then the IRS is going to say,
Yeah.
you can't do that. And it's like home builders. They can't do 1031 because they sell inventory. They don't sell investment property. So that's just kind of the spectrum we go. And 1031 is designed to defer taxes. It's not a loophole. I hear that word bantered around a lot. I hate that word. It's not a loophole. It's not a way to cheat the government out of taxes. You're simply kicking the can down the road. At some point, unless you have some other way to structure your deal so you get rid of the tax or avoid it, you are going to pay tax at some point if you cash out. Only way you
have to
don't,
cash out.
yeah, if you die and leave to your heirs currently, they get a stepped up basis and there's no tax due. If you convert it from investment to primary and you satisfy the primary residence requirements and get the exclusion, no capital gains tax due. But if you're simply holding it and you're gonna sell it in the future, you're going to pay the tax when you cash out. Go to the next slide. Let's go to the next one. Okay, I'll do a little quick analysis here. I've been talking about taxes. Yeah, next slide. So if you're trying to get 100% deferral, which most clients who call me, this is their goal. You want to do three things. You want to buy a replacement property that's equal or greater in value. You want to spend all the cash that you get at close. So that's going to be net of closing costs. And then if you're paying off a debt, you want to replace that debt on the acquisition side. So we'll go to the next slide. I'll show you some visual numbers, right? So if I have something that's worth 2 million, it's got $1 million mortgage against it, and I'm going to sell it, which means I'm going to net out $1 million. Excuse me, because I'm going to ignore closing costs for the moment. If I want 100% deferral, I need to look at my three little tests: equal or greater in value. So here I sold for 2 and I'm buying for 2.5. Spend my cash. I get $1 million, I'm spending $1 million, and replace my debt. I paid off $1 million, and because I went up in value, I needed more debt. So I went equal or greater in debt. That's 100% tax deferred transaction. We call that no boot. It's just a term of art, meaning if you get something that's not like kind, what we call like kind, which is real estate. If you end up with cash or debt that you don't replace, it's called boot, and you get taxed on the boot.
So if
Now-
they bought a condo, if they sold a condo and bought a single family, that's still okay? It's considered
As long as
like,
it's investment.
and it's real estate?
Yep.
Okay,
That's our two requirements. We want it to be real estate and we want it to be held for investment. You do those two things, it can be any kind of real estate, single family, commercial. It can be non-traditional real estate like a Delaware statutory trust product or a cell phone easement or billboards, or there's all kinds of things you can buy. But
Not land.
mostly for us, it's real estate.
You cannot buy land.
You can buy land,
Land.
absolutely.
because it's considered real estate.
The only issue you have when you are switching types of real estate that way is when you're going from a non-depreciable to a depreciable and vice versa. You could have some depreciation recapture issues present, but it's still considered like kind. So if you had a single family for a couple of years and then you bought land, you probably don't have a lot of depreciation there. And it would be straight line anyway, so you would get deferral on it. If you take an accelerated depreciation, we have a different analysis, but it's still like, and you shouldn't have a recapitalization, but that's the only thing that could come up.
What are examples of depreciating properties,
Say that again?
like the depreciating properties that you were saying?
Why would you do that?
No, what are examples of those type
Um,
of properties?
One's it flooded?
Well, so anything that is not land
Mhm.
that has a structure on it is going to be depreciable for tax purposes. So if you buy a residential investment property, it has a 27.5 year schedule. You take the value of the asset, you don't include land, just take the value of the asset, divide that by 27.5. For the next 27.5 years, you get to take that number as a deduction on your tax return.
Okay,
What happens with investment property is that depreciation builds up over time. So you started out with, let's say you start out with something that's 100, and now it's 20 years later, you depreciate that all the way down to like, let's call it 20. So now when you sell, you've got gain plus recapture. And they tax those things differently. So recapture gets taxed at 25%. Capital gain gets taxed at whatever your rate is, 15 or 20. So it's not as problematic early on in the life of an asset, but it becomes more of something to concern yourself with later. Commercials like I think 39-year schedule. And then the problem, not problem, but people being aggressive. If you've ever heard of what do they call it? It's slipping my mind, but what they'll do a lot with commercial property is not only do you look at the building, but you look at the fixtures and the electrical wiring and, the hardware, and you can depreciate all these things at different schedules and more quickly on some than others. And so they'll take a ton of that depreciation. And then because nowadays, the electrical wiring, that kind of stuff is not real estate, it's personal property, you can't exchange it, you end up in an issue. A situation where you've got recognition in on top of the game. So we can get a little crazy. So that's a good example of 100% deferral. You don't have to do this. If you want to have some tax consequence, partially deferred exchange, perfectly okay. But most people don't want to pay tax. That's why they're doing this. But if you wanted to, like the next slide, show you have $1.2 million of debt. I mean, $1.4 million of debt, and you only replaced $1.2 million. So now you're short 200 grand. That means you're going to have boot of 200, which means the transaction's partially taxable. And people use the tax consequence to their advantage a lot of times, meaning, let's say I have some loss carry forwards on the books that I can offset against capital gain, then I might as well get rid of this, take some recognition, because maybe it's a net tax consequence to me, and get deferral on the balance. Or I just need cash. I'm selling and I want 50 grand just because I want it. Take your 50, pay your tax on it, get deferral on the balance. So it's not an all or nothing proposition. Go to the next slide. A lot of reasons to exchange. The primary one is people want tax deferral. That's why they normally do these. But there's a whole litany of other reasons why people do this. Lately, a big one has been, we have such an influx of people from other parts of the country as a result of COVID and the like. People want to take their investments that were in New York and they want to move them to Florida. So they're doing it not only to get the deferral, but to get the properties more accessible to them so they can manage them more effectively. But anything you see on this slide here, people have articulated this as a reason, and it's a legit reason if to help you do a 1031. We'll go to the next one. Go back one slide. So taxes are what's important to people, right? So if you own something for less than a year, it's short-term gain, which is your ordinary income tax rate. If you own something for a year and a day, now you're in long-term capital gains. And it just depends on your income bracket as to how much capital gains you are subject to. So if you see here, if you have an income below $492,000 as a single person and 553 as a married person, we're in the 15% long-term capital gain bracket. I would say most of my customers that are not institutional customers fall in that 15% bracket. If you earn more than those numbers, then you jump up to the 20% depreciation category.
But it's still less than, well,
It's still not bad. I mean, I have this conversation with people all the time. It's like waffling, do an exchange, don't do an exchange. And you would think I would just tell them to do one, but I'm just not that kind of guy. I really want them to do what's best for them. And I will say to them, I've been in exchange since 1996. The long-term capital gain rate right now is the lowest it's been since I've been in the exchange business. So it's historically low. Right? So maybe now's the time to take advantage of a low rate, because I know when Biden came into power, one of his initial things in his budget was to raise it to 39%. I mean, that's a big hit. And we don't know moving forward what any administration will do. If they decide they need to raise income or generate income or revenue, they may raise the rate. We don't know. So sometimes it makes sense just to pay it and be done with it. But if you're staying in real estate as an investor, to me, it makes more sense to do an exchange because you get to move all the money forward, not net of a tax bill, right? So we'll go to the next slide. So you have these long-term rates that are applicable when you sell investment. You have the depreciation recapture I mentioned when you sell. Then if you're over 200 as an individual or 250 as a married couple, you also might have this net investment income tax that's due. So your tax bill, we'll go to the next slide, can be really significant if you're selling an investment piece of real estate. Okay. So this is just a quick one of what I'm saying here is I bought something in the past for 100 grand. I took 50,000 of depreciation against it. So on the books, it's worth 50,000. Now I'm going to sell it for 800. So what do I have in the way of gain? I've got 700 in capital gain and I got 50,000 in recapture. And then I just plug all those numbers into the particular percentages that might be due. And you can see here, if I'm in the higher bracket, I could sell my $800,000 piece of real estate and write a check to the taxing authorities for 203, 350. I can do what I want with the balance. Same if I'm in the lower brackets, 180. If I'm gonna stay in real estate, I can buy a lot more real estate with that extra 180 or that extra 203 than I can with the net number. So this is why you should do exchanges if you're staying in real estate.
What's the timeline that you have to, I guess, apply to do the 31?
We're gonna do that next. We'll do that next.
Just got a question. Me being an older guy, would there be any, we have probably still about a dozen rental properties that we've had 15, 20 years and longer.
Mhm.
Of course, they've been depreciated and
Right.
everything. Would there be any reason to do a 1031 to maybe get rid of a few properties?
So maybe you could think 1031 would be helpful if you don't want to pay the tax. And maybe you could consolidate, or maybe you could go into something that's not as management intensive. So there's a bunch of reasons why you might want to.
Newer property.
And then the other thing though would be, if you can control your income on an annual basis, and you can dispose of an asset when your income is below, let's say as a married couple this year, it's like almost 90 grand. If your income is below that number, then it's a zero capital gains rate. So if you sit with a tax planner and say,
So I shouldn't work.
yeah, stay home, exactly. But if you have a year where you don't work, and maybe you're only drawing Social Security or something, and so your number's not gonna be above that threshold, maybe that's the year to sell one asset, because it's all tax-free. So just, that's a good idea for you to talk to a financial planner or CPA, because you might be able to set it up that you can have some sales and not have any tax consequence.
Okay.
We'll go to the next slide here. Let's go to the next one. We already talked about like kind, that's any kind of real estate that you hold for investment. As long as it's not your primary residence or a second home, it's probably gonna qualify. We'll go to the next one. Next one. Sorry, I keep telling you to do that. So we'll do this real quick and then I'll talk to you about the timeline. And then I'll tell you the options that are available on the timeline, and then we'll be done. Because I think we started a couple minutes late and then we'll be done in 5 minutes. And with that said, if you ever have questions on this process or anything about 1031, just email me, call me, text me, whatever you want to do. I have everything you could ever dream of related to this topic at my fingertips. So what's a qualified intermediary? We're the ones that are creating the exchange for the taxpayer. So we're doing a bunch of documentation, getting it all in place at close or prior to close, so that at closing, instead of it looking like a sale, it's going to look like an exchange, and the money's going to come to us to safekeep for the customer. Then on the acquisition side, we're going to do the same thing. We're going to do a set of documents. We're going to move money. Transaction closes. That's an exchange. For you, it's going to look like anything you've ever done. You're going to list. You're going to get a buyer or seller. You're going to arrange for a closing. You're going to hire a title company. Everything you do, status quo. The only thing is you're going to add my process into part of the transaction. If I'm doing my job, it's transparent to you. You don't have to worry about anything. The main thing that you should take from this, though, is we're an unregulated industry. So I happen to be a lawyer. This is all I do, but I could do this and not know a thing about 1031 if I wanted to. So we're unregulated, and which means that You don't have to have any special training, no licenses, no nothing, right? So the key there is, in an exchange, you're giving the qualified intermediary the money. Your expectation is you're gonna get the money back. I think that's the
Oh,
expectation.
brother.
And so if they don't give it back to you or something happens, it's really just a breach of contract. Unless you're dealing with a company like ours, or there's a couple others in the industry. We're all owned by really large title insurance companies that are publicly traded. As a result, we are bonded and insured. And so if you're looking for a QI, my advice is hire a corporate qualified intermediary that's bonded and insured, so that there's a problem, nobody's pointing the finger at you for
What
making a
about the
referral.
fees are flat fees or is based on?
Yeah,
percent?
most of the time it's a flat fee. Me and my primary competitors, we're all flat fee. And I mean, mine, for example, if you're selling one and buying one, we charge a flat fee of $1,200.
Mhm.
$1,250. And that covers the sale and the purchase, gives you all the bonding and the insurance, everything's included. No garbage fees, no wire fees, none of that kind of stuff, right? So that's what our industry does, is we are papering the file to make it look like an exchange instead of a sale followed by a purchase. Now, when you're doing these things, there's a defined timeline. And it's 180 days, right? So if you have a customer, so if you have a customer that wants to do an exchange, they need to communicate with the qualified intermediary prior to close so that everything can be put in place. And at close, it's going to start the timeline. So you have a total window between the time you close on your sale and the time you close on your purchase of 180 days. But it's actually broken into two pieces. You have 45 days from the day of closing of your sale to identify what it is you might acquire. And then you have the balance of the timeline to actually close on something that you did identify. Now, those are very rigid dates. So you have to have identified by midnight of the 45th day. It's got to be in writing. It's got to be delivered to someone, usually it's me. And once that time expires, you don't get to change it or add to it or do anything to it. So if you're gonna identify properly, you need to make sure you do it by midnight of the 45th day. There's a couple different rules. One's a 3 property rule, which will let you identify up to 3. We don't really care about the value, we just care that there's 3. There's one called the 200% rule, which we take the sale price times 2. That gives us a number. Then you can go more than 3, but when you add up the value of those together, it can't be more than 2 times your sale price. Most of the time, people use that rule when they're diversifying their portfolio. So you're gonna sell a big $2 million asset, they want to end up with 5 or 6 $200,000 assets or so, we'll use the 200% rule. But if you're selling something for 2 and you're gonna buy something for 2.
Identify means to be under contract or is a document in particular?
So you just have to write the property address down or legal description. My advice is be under contract by day 45.
Yeah.
That way, absent any craziness occurring, you know you're gonna be able to close on something that you identified. The problem people have is they procrastinate the ID stuff that they may not even be on the market, or maybe on the market might get sold. And then now they're in a situation where they can't replace it with anything. And so they're gonna end up having a failed exchange. And I don't like to have taken my fee and done all this work and then they don't get the success that they're hoping for. Not that it's my fault, but I just don't like that to occur. So I try to get people to be diligent about those processes, because it doesn't matter if it falls on a weekend or a holiday, you still gotta comply. And the only time there's ever an extension is if there's a disaster declaration, and we don't want that. You don't want that,
No.
because it means you're in a disaster area or your property's in a disaster area, and that's never a good
So
thing.
it's 45 calendar days, you know,
Calendar.
calendar.
45 calendar days, correct. 45 calendar and 180 calendar.
So 45 days from the sale
Closing
to
of
the
sale,
close.
Yeah.
Huh?
from closing of sale,
Yeah,
45 days to ID.
to be.
To
identify your
Under
next
contract.
purchase.
I thought you said under contract.
You don't have to be.
Should
That's
be,
a good-
but
that's a good thing.
Good practice to
Right.
be,
Yeah,
yeah.
best practice would be under contract, but day of close, in fact, we'll skip to the timeline,
And you need
so,
to close.
if you just go a couple more slides. Keep going, keep going, keep going, keep going, keep going, keep going, keep going. One more, there we go, this is the timeline. So day 0 is the day of closing of your sale, 45 days to ID. balance of time to close, up to 180. Again, these are rigid dates, generally no extensions, no, latitude on these, you gotta be in compliance. The other thing two quick things and then we'll be done. I think we started
You're fine.
10 minutes, we'll
Yeah.
go, because I know people on Zoom are probably going, stop talking. Couple things here, go back one slide. What types of exchanges can you do? Really, there's two with variations. So simultaneous, for me, that means closings within 24 hours of one another. Very easy to do if you're selling and buying in Daytona, not so easy to do if you're selling in California and buying in Florida. Okay. But they can be done. We do quite a few concurrent transactions. The most common is what's called the delayed exchange. And that's that timeline I just showed you. Day 0 is the day you close on your sale property, up to 180 days to close on that replacement property. Now you can do a couple of different variations on this delayed process. One would be what's called an improvement exchange, which allows the QI to use exchange money to make improvements to real estate in order to get you to your requirement of equal or greater value, spend your cash, replace your debt. Or you can do these things backwards. You can buy first and sell later if you want to. Now, in the improvement and in the reverse process, there's an additional layer. We call it a parking arrangement. So what ends up happening is I create an entity that either buys something and holds on to it, or buys something and fixes it or improves it. And then we finish the exchange at a later period. Those two variations are significantly more expensive because of the fact now I own something when I don't in a normal exchange, but they are an option. So that's we know the timeline, and the timeline's the same regardless. If you're going forward, it's 180 days. If you're going backwards, it's 180 days. The only difference is that this timeline start in a reverse, for example, timeline starts when I buy it for you. Then you have 180 days to sell something. But we can do these. We do a lot of them, and I've been doing a ton of these lately for my institutional customers because it's really easy for them to find stuff because they're all cash buyers. And now they have plenty of time to get something sold to match it up. And they have cash, so they don't care. In fact, I have a couple one that's closing hopefully today. I'm surprised my phone's not blowing up, but it's $145 million transaction. It's an apartment complex. And it's a mix. We got part delayed, we got part reverse. It's crazy. And then I have another one that I'm on a phone call tomorrow. The purchase property is worth $1.6 billion, believe it or not. And they have all these different ones that they're selling, some of which we're doing forward, some of which we're doing in reverse. It's all over the place. And so we have a call tomorrow to figure out, okay, what are you going to be able to get sold before we have to make the acquisition? And then what are we doing with all these pieces that we're going to need more time with? And so they're an all cash buyer as well. So for them, the expense is negligible. They have cash, they don't care, they don't have to worry about lenders, etc. Let's go scroll through the slides again. I think I'll just leave it at that. Like I said, though, for those of you here, I gave you this little brochure. It's got my business card on there. Feel free to reach out to me. All of these things I'm mentioning, I have probably in a PDF form. So if you have a customer that asks you a question and you know what you want them to see, but you're not prepared to answer it, just contact me. I can send you the PDF. You can forward it on. Or they can call me. Their tax advisor can call me. It makes no difference. I'm here. I want to help. So if you have a 1031 deal that comes up, just let me know. Thanks for your attention.
And that's your info on here.
If anybody else has any
Feel free
questions
to take a picture of that.
after we zoom the people
Yeah,
off,
thank you.
you're welcome to ask me, or again, contact me at your convenience. I'll answer whatever I can. All right, we'll stop there.
I think we're good in the Zoom.
Thank you so much.
Thank you guys in Zoom land. Yeah, I was going to, you had given an example of why